Warren is the host of Honest Money podcast, and he is the author of 2 best-selling books, How to Make Your First Million and Become Your Own Financial Advisor. So this morning session is 2021. Is there light at the end of the tunnel? There is some current concerns around, at the moment, government's ability to implement reforms timeously. But Warren's going to look at whether there is light at the tunnel, and he's going to give us some views on what investors should be doing during this time. So Warren, over to you.
Thanks, Vikeshni, and thanks everybody for joining. It's amazing to see the geographical spread of all the attendees. I must say it's probably the first time I've spoken to people from so many different regions all at once. So thank you very much. And as Vikeshni says, I'll certainly look at your questions as we go. My brief is to talk till about 9:30, and then we can go through your questions, and hopefully we'll get through all of them. I was thinking about when to do this poll, but I'm actually going to start it right now, if you don't mind having a look. And let's just see. Let's just see if we say continue. No, Vikeshni, just to check our poll there, it's still on test polling. There we go. Option 1, launch polling. So I guess self-explanatory question for you, but just what do you think the economy is going to do in the next 3 years as opposed to just the next year? Because obviously there's quite a lot in our lives happening right now, and it'll just be an interesting point to look at, and then for me to talk through to the end of the presentation. So we're already at 65%. 75. I think if we get to 75, we'll cut it. It's probably a good representation. Wow, you guys are fast. Okay, let's end the poll there. Thank you very much. So 44% of people think it's going to grow, and then the next best is shrink and then stagnate. Thanks very much. So let's talk through what's gone on in our lives in the last while. I think if we think about the South African economy, kind of pre-COVID, we were living in a time of great uncertainty already, and already a difficult time for the economy. We were, certainly as businesses and investors, kind of urging government to act with speed to speed up economic reforms, take some difficult decisions, make some tough compromises, and then COVID hit and accelerated the need even more. And I think that we can. I'm certainly not a virology expert, and I guess many papers will be published about COVID and the impact of lockdowns and the like in the years ahead. But what I can tell you is that the impact of that hard lockdown at the start of 2020 was severe, and I think it caused enormous damage to an already fragile economy. And I think that's the context of where we kind of arrive, into this year. Looking at 2021, we were kind of thankful, I think, a lot of us that 2020 had passed, and we were hoping for kind of a new, renewed beginnings, and unfortunately, we entered another lockdown. And I think that the concerns, talking to investors, I think there are a lot of concerns about government's ability to actually get these vaccines. I mean, we're seeing updates all the time. I see our Minister of Health saying last night that they have now procured enough vaccines for the country's population. Obviously, the details of the rollout is really next, and I think that's where a lot of concerns are. It's, I think the need for transparency from government about how they will work with the private sector to get these vaccines actually into the arms of everybody around the country that needs them as fast as possible is what we're all waiting for. And I think that will probably be the last big hurdle that the country needs to face around this pandemic is once we know, I'm not saying that we need the actual vaccinations to have happened and to get to that herd immunity that we've all heard about, but I do believe we will need to get, we will need actually a proper plan that inspires confidence in all of us. I think we need to see pharmacies being involved. We need to see the private healthcare sector being involved, and we need to see those plans now. I think once we see those, I think that helps a heck of a lot to start to restore investor confidence. And I mean, I'm talking to the Institute of Directors. I don't need to tell you about business confidence. You already know that it's low. You already know that a lot of us are stressed and concerned about our businesses, about the economy. And so, you know, the government needs to do a lot to try and get us going and get us in the point where we feel much more confident about the future. So it's really interesting to look at that poll, because I had a little bet with myself that over a 3-year period, most people would anticipate the economy stagnating. And so to see that there is a level of optimism there, I think is great. And certainly as a natural optimist, I think that you know, ties in with my belief. But I think the general pessimism that we see around the country needs to be resolved fairly quickly. You know, I think one of the things we can't underestimate from an investment point of view is the impact of sentiment. You know, it's the impact of how we feel about business, how we feel about investing. And the moment we start to become a little bit more positive, that can become a really positive snowball rolling down an increasingly steep hill, and that snowball can change the whole direction of our economy and our investment markets. So a sentiment change would be a massive benefit to all of us. So is it all doom and gloom? You know, I look at this all the time. One of my good friends always accuses me of being overly optimistic about South Africa, and certainly there are lots of my contemporaries in the media who make a great living by inspiring fear and forcing people almost through kind of moral imperative that they need to sell their retirement fund, send all their money overseas because South Africa is a basket case. And I don't subscribe to that at all. I think we've been through our worst. I think there is some light at the end of the tunnel. And I don't do that just from a point of belief. I think there are a few things that we can look at already which are having an impact. I'm sure a lot of people would be really surprised by the strength of the rand at the moment. And I'm not surprised. I think that certainly I'm not a predictor of the currency market, but if you look at the appetite from investors around the world for emerging markets in general, you know, there's almost a decade of lost appetite for emerging markets, and that's switched on again. So we're now seeing investors, you know, climbing into emerging markets, you know, in a big way. To understand what emerging markets means for a global investor, we need to appreciate that for them that means Taiwan, China, South Korea, some of Asia, a little bit of South Africa, and a little bit of South America. There are whole parts of the world that a typical global investor would just disregard when they're looking at emerging markets. So just to understand that we're benefiting from a trend and a global trend back to emerging markets, but that's certainly not the case of global investors becoming massively optimistic about South Africa on its own. It's much more a case of that they see value in global markets, and especially in emerging markets. And one of the reasons is because they can't find interest on their money. You know, if you're a European cash investor, you are in the terrible position of depositing cash and seeing your cash erode in value every month, because they actually charge you a negative interest rate to deposit your money in a bank in Europe. America is not much better, with almost zero interest rates. They're also very low, and places like Switzerland also negative interest rates. So in a country like ours, where we're unhappy when we're a cash investor to earn 5% a year, that looks amazing to a developed world investor at the moment. And that sort of situation replicates across a lot of emerging markets. So there is a search for yield. And then we've got another trend, which is kind of picking up speed again. And that's the whole commodities trend. We're seeing the price of some of the basic commodities, you know, like iron, steel, copper, and even the oil price, you know, recovering quite substantially. And that's because we're seeing central banks and governments around the world all trying to restart their economies post this COVID pandemic with infrastructure projects. China was very quick as an economy to start at the end of last year, which is why the commodity prices picked up so quickly. But we'll expect to see that across the globe, and certainly South Africa is no exception. You know, we can all read about the big projects in KZN with the N2 and N3 revival, And I'm not going to talk about Transnet because I think we need to see some action there, not words, but even Eskom and the whole electricity sector, we will see maybe not investments by Eskom, but certainly by the electricity sector. And all of that is very positive for the commodity cycle. So those are the reasons why investors are at the moment buying South African shares, South African bonds, and even storing money in South African cash. And I think that trend doesn't last for 3 or 4 months. That's often a multi-decade or at least multi-year trend, if not a multi-decade trend. I think my optimism is kicking in there. It probably won't be a multi-decade trend. There are other surprising things that happened last year which are helping the JSE. One of those is we actually had a trade surplus last year. In other words, we imported less than we exported. And that's down to the commodity cycle. It's down to a brilliant agricultural output from the farming and agricultural sector. And that helped a lot to make the rand a bit stronger than it needed to be, and gave Treasury a bit more money than they were hoping for. So those are the positives so far, and some of them are expected and some were unexpected. What are the things that need to happen, I think, for us to become even more positive? To me, the one is around the fund manager sentiment. It's the first time that I've listened to the fund managers in South Africa and globally predicting higher rates of return, higher growth rates from South African shares than they are from international shares. And that's when you price the South African stock market in dollars. So what they're saying is, doesn't matter that the rand might weaken over the next 5 or 10 years. Even with that weakness of the rand, they're still expecting investors to get more return from the JSE than they will from US shares, European shares, and the like. And that kind of a trend is very positive, because it means that South African fund managers and global fund managers are starting to buy more South African investments, and they're actually starting to sell some of their international investments. And that's a major turnaround from 2-3 years ago. Even a year ago, there wasn't a fund manager running a big balanced fund in South Africa that wasn't 100% allocated to the international markets. As much as they could, they were investing overseas. And now I'm seeing big fund managers running very big funds where they've reduced their international exposure from the maximum, which is 30%, and it's down to 25 or 28%. And that's a significant move, because that, the big balanced funds are where most of our pension fund money is invested. And if that's coming back into the JSE, I think that's very positive. For that trend to continue, we do need to see a little bit of action from government. And I think, we don't lack great plans at government. I think that our government has had a history of developing really high quality economic plans. The issue is not the plan, the issue is implementation. I'm sure it's not something new that I'm telling you, but unfortunately, the runway or the leeway for government to avoid implementing plans is now over. It now needs to be, it now needs to happen now. And I think that runway is really short. So I'm really hopeful that we see, some news around the broadband spectrum auction soon. I know there's some court cases that are coming, but that's an economic multiplier that will generate a lot of money for the country, and also for the fiscus as a whole. And it does create new economic opportunities. The recent news in the State of the Nation addressed by our president around renewable energy, new IPP projects, and then the deregulation of the 1 to 50 megawatt market is fantastic news. It's something that lots of us have been crying out for 3 or 4 years already. And I think that will also release a lot of capital into the market. So those are actions that need to happen very soon that can have a very positive impact on the market. And that's very positive for you and me as investors, understanding that the future isn't just negative, and that we shouldn't just be focused on sending all of our money out of the country and just growing our businesses and working in our businesses and being investors everywhere else. We can actually now expect to see very positive returns from our retirement funds. Lots of us have got used to looking at our RA or pension fund statements and seeing no growth over 5 years, over the last 5 years. And I think that cycle certainly is turning. So for you as investors, not to tell you what to do in business, but certainly to give you some ideas and some pointers around the investment markets and potentially what actions you can take to improve your financial position and take advantage of any opportunities. I think the first one is around our interest rates. While we've got great interest rates for compared to foreign investors, they're still very low compared to our history as a country. How much we charge or we are charged by the banks when we borrow. And so if you have debt, if you're sitting on car debt and the like, I think we need to view the current interest rate environment as an opportunity to actually pay down our debts much faster than we might have done in the past. I'm conscious of the economic climate we're operating in. I know money's tight, and I know possibly prospects are for kind of extra savings are limited. But to me, this is going to be one of the opportunities we get as people who have debt to pay down our debt faster. So I wouldn't necessarily be embracing new debt at the moment as a private individual for things like homes and consumption, cars and the like, because I think that actually what we should be doing is getting rid of that kind of a debt now. And maybe we're embracing debt for our businesses, but certainly not on the individual side. Interest rates can't stay at these levels forever. And whether we're talking about 2, 3, or 4 years' time, the interest rates will need to rise again. And this Reserve Bank has shown that they hate inflation more than anything else. So if they start to become concerned about inflation, they certainly will start to raise interest rates very quickly. And by then we'd like to have made a big dent in our debts if possible. So I think that it sounds like a boring comment to make, but certainly it is an opportunity to take advantage of. I've spent quite a bit of time already talking about the prospects for the JSE and for the local investment market. That's not to say that you should exclude international investments altogether. I think that would also be a mistake. What we need to know is, our JSE makes up a very small part of the world stock markets. And if we want access to, the tech companies, both the ones that are in favor now, but also the tech companies of the future, whether they be pure tech or biotechnology and the like, we need to be global investors as well. And I think we need to do that quite strategically. And so I think, there are kind of 3 broad categories of investor that the world kind of breaks up into. And for us as South Africans, if you're in a position where you're going to retire with just enough money, if you know that you're going to work really hard, get to age 55 to 65, stop work, and have sufficient money to fund your own retirement, but not really leave much behind to the next generation, then I think you need about 25% of your investment assets to be invested overseas. That should give you a good measure of diversification, good exposure to other countries and other companies where you get additional growth, and also reduces some of your risks of being all invested in one place, in one country at the tip of the continent of Africa. Having said that, if you're in a position where you're going to leave behind money to the next generation, to your children, for example, then I think you should increase your overseas allocation to about 50% of your assets. So that's an important point to understand. It's not just your investments. I'm talking about all assets, the value of your house, the value of any dead assets that might be holiday homes or those kinds of things. I think you need to move to about 50% of those assets need to be invested overseas. My logic is that you need to protect your capital for the next generation. And that means you need to protect against things you can't possibly predict will happen in the next 25 to 50 years. And you don't know where your kids will study or your children's children will study or where they'll want to be. We live in a global world where the youngsters are, that they do travel and they do want to get work experience elsewhere. And if you potentially need to fund some of those expenses for them, then you need a greater proportion of your capital to be invested overseas. If you're in the top 1% of the top 1%, and that means you're going to leave behind money to your children's children, then I think you need to increase that overseas allocation to about 75% of your assets. And again, that's about diversifying risk across many different countries, many different sectors, and making sure that you're looking 50 to 100 years ahead. And when you're looking 50 to 100 years ahead, you should try and replicate what the world stock markets look like, more so than what you look like just in South Africa, or just with the JSE. And the world stock markets, they'll allocate about 3 or 4% of their money to South Africa. So, just understanding that, 75% is still a big over allocation to, well, I guess 25% in South Africa is still quite a big over allocation to our home market. But that's the reality, that if you live here, you should have extra money invested here so that you can cover your expenses in rands. People often ask me about the allocation to international assets and what exchange rates we should use. I think at the moment we should be converting rands to dollars at about 15 rand to the dollar. 20 rand 50 to the pound, and 18 rand 50 to the euro. So just to explain, if the rand is at 14.70 to the dollar, then it's a good time to be sending your money out. If the rand's at 16 or 17 rand to the dollar, I would be patient and I'd wait for the dollar to come back. I think it's also critical that that you make sure that you're properly diversified. You know, we've watched a lot of big little bubbles building in international markets, whether it's Tesla's share price, you know, the price of Zoom as a company, or Bitcoin and the like. And watching those bubbles, it's often tempting for us to kind of over allocate money to those kinds of investments because they're doing so incredibly well. The problem with that is that they often turn. You know, we've seen, you know, the GameStop story where, you know, one little share just absolutely rocketed in a few days and then collapsed a few days later. And so don't invest on the basis of missing out, you know, on the fear of missing out. I think, you know, rational diversification and making sure that you've got a lot of money invested in many different sectors, in many different countries makes a lot of sense. Because the truth is, we don't know how the world unfolds in the next 5 years. And so you could hear people like me talking on the radio about the American stock market being expensive, and especially the tech sector. But that doesn't mean that the tech sector won't get 5 times more expensive. We don't know the answer. So I think the critical thing there is to make sure that you've got some exposure to the tech sector, but also exposure to other emerging markets, you know, other developed countries as well, so that you're always benefiting from some growth, even unexpected growth that catches you by surprise. And to me, if someone says, you know, how do I build a global portfolio? At the moment, I think, you know, allocating about 70% of your capital to the developed world, or you know, to the world index. The jargon for that is the MSCI World. Makes a lot of sense to me. So putting, you know, 70 out of every $100 that you invest overseas, I think that's a good allocation. And then about $30 to emerging markets. And you know, there is a generic index called the MSCI Emerging Markets Index, which is a great place to allocate money. And to me, that's quite a nice spread where you're going to get exposure to tech shares, to the emerging markets. You're going to benefit from a range of different economies growing at different times, but at the same time, you're not overexposed to one place. In South Africa, I think if I'm looking at how I would allocate money here, I would make sure that I've got quite a good spread of assets as well. I wouldn't just be invested in 5 shares, or, you know, a lot of us, if we're in a retirement fund, we've got a massive exposure to Naspers already, because that makes up, you know, over 20% of the value of the JSE. And if you add Richmond and Anglos and Billiton, you've got a few shares making up a large part of the stock market's value. So if you're going to do that, you know, look at something like a top 50 index, you know, which is nicely spread, and don't be shy to own a proportion of your money in bonds as well, because I think the South African bond market is, you know, is quite lucrative at the moment. And then I think just you know, as a comment to you living and working in South Africa, and you know, kind of getting stuck in the media cycle that we operate in. My one comment there is, don't be too negative about what you read in the media about the prospects of South Africa. I feel like a lot of the good news, it kind of gets understated in South Africa a lot of the time. You know, our media houses give a lot of attention to dramatic stories, you know, whether it's about Edward Zuma, you know, talking about his father, or Julius Malema talking about something. And that's not really, to me, a reflection of what's going on in the investor's mind, or necessarily what's going on in the whole of the country's mind. You know, South Africans, I think, are naturally quite optimistic. So kind of overvaluing what you read on social media, or overvaluing what you read just in the general media, I think could make you quite negative and potentially miss out on a lot of investment opportunities in South Africa. So I think, you know, there, just make sure that you are you're kind of curating your consumption of news. Make sure that you don't become part of the herd. You know, I think a lot of people last year were panicking, you know, around about March, April in 2020. And I saw a lot of people selling out of their portfolios and moving their money to cash. And I looked at some research that the behavioral finance unit at Momentum did about this. And investors lost about 20% of the value of their capital by switching out of markets into cash and then missing out on that recovery. And that's a big number. You know, if you miss out on 20% in 1 year, that's a heck of a number. And the reason they made that loss was because they made a change at the wrong moment in time. Why did they make the change at the wrong moment in time? Because their friends, family, the media were creating a fear cycle that, you know, that becomes a self-fulfilling prophecy. And I think the best investors I've seen over decades, both in South Africa and globally, are very cautious to become part of the herd. You know, they often think in the opposite direction to the way the world is going at the moment. And I think that's a very good way to think about your own investments. And to me, you know, if I have to kind of adopt an approach for how I'm thinking about South Africa at the moment as an economy, I've got a level of cautious optimism. I think, you know, I'm really concerned that we get a decent budget in next week. You know, it's critical that we don't get overtaxed as a country. I think we're carrying as much of the tax burden as we can already. And then secondly, I think we need to see a resolution on the Eskom debt issue. You know, that's a massive sword hanging over our heads as a country, and we need to know what that's going to look like. And then lastly, we need to see some of those structural reforms that we've been promised by our president for a couple of years now. And I can't tell you how excited I am about, you know, about them moving ahead with Eskom. You know, both the deregulation of the smaller self-generation, and secondly, that breakup of Eskom into the three parts, where we see a transmission company able to buy power from independent power producers much more quickly than we've seen in the past. I think that will be a massive sentiment changer for South Africa. And if that happens, you know, it creates a positive cycle. So my last comment is, you know, when you consume news, just be careful. You know, I think go on the trusted news sites. Be careful of the talking heads. You know, there are quite a few talking heads that are really astute at manipulating our emotions in the media, you know, whether it's on social media, on radio, or on blogs, you know, and they talk a good game that really suits themselves and their interests. And you know, there are a few operators here that I think are doing it purely for self-interest, and that's a critical thing to understand. That you know, there's some talking heads out there that are not giving you information based on what's good for you, but based on what's good for them. And I think that's a really dangerous place to be. So consume your news carefully. Follow the good news if you can, because I think there is quite a lot of good news that's coming. And don't be too pessimistic when we get bad news. You know, we are an emerging market. We are a young democracy. We are going to make mistakes from time to time. It's always messy, but I think the trend is certainly positive for now. And we need to be conscious that we don't become too pessimistic. So I think that's 9:30. I'm going to have a look at the questions now and then address them as we go. So from Clive Pillay, so there is optimism from investors for emerging markets, but stable investor-friendly policies is a prerequisite. In your view, what can South Africa do to improve its policies to attract foreign investment? Great question, Clive. I think the first thing is we need to be we need to make sure. I'm just looking at Vikeshni there. Vikeshni, did you want to say something? No, Warren. Oh, okay, great. So I think we need to be careful that we make sure that our policies become stable. So I think we've had so much policy change over the last decade, and most of those policy changes have been to the negative. They've been investor unfriendly, you know, very labor friendly, you know, kind of very union friendly. In fact, I wouldn't say labor friendly. I think sometimes there have been lots of unintended consequences that have cost jobs. So I think, you know, investors firstly want to see stability. They hate uncertainty. So if we can get to a kind of a static regulatory environment for a period of time, and secondly, where we see policies being implemented as promised, that would get a lot of investor confidence. And I think, you know, things like the land expropriation issue, you know, that needs to get through our parliamentary process. It needs to become law. It needs to be implemented in the correct way. And it needs to give investors confidence that we're not going to see property as opposed to land being expropriated needlessly. Investors don't want to commit capital to South Africa and then have it taken away in an arbitrary process. And so far, looking at the land expropriation issue, it's not arbitrary. I think it's a very rational, very considerate way of implementing expropriation, but it now needs to get done. We need to stop talking about it and get it implemented. I would say also things like prescribed assets, which was a kind of a big thing that came out of the 2017 ANC conference. That needs to be officially put to bed to say this is not a policy of this government or the ruling party. We've heard different people from within the ANC saying that and different ministers saying it, but we haven't seen it as an official thing to say we've put this to bed, this is how we're going to fund Eskom. And I think that that's another issue that needs to go. Lunga Mkize saying, I don't really see correlation in the growth of the stock market to company profits. Do you see significant improvements in profitability in the long term post-COVID? You're right. So company profits over a decade should track the growth of the stock market, but sometimes the stock market grows faster than profits will, because investors start to anticipate that companies will generate profits in the next year or two or three. And I think that that's a critical point, that the markets always look ahead. So what's happened in our lives in the last 5 years with terrible growth from the JSE, bad retirement fund performance, all of those things, it almost becomes irrelevant to an investor, because what the investor wants to know is, what am I going to get out of my money if I commit money in the next 5 years? And so that's an important thing to say. If investors are anticipating future profits from companies, then they will start to buy those companies and they'll start to drive those prices up. That doesn't mean investors are all rational all the time. So if you look at the Tesla share price, it's not possible that that a company will generate profit growth of whatever it is, 200% a year every year for the next decade. It's not going to happen. So investors do become overly optimistic, and that leads to market crashes, because we have huge bubbles that form and then those bubbles burst. I'm not saying that about South Africa at all. I think the South African market is very cheap. I think profits can rise. And I think all of us, we know people that have lost jobs. We've seen companies closing down. And if that's happening around you and your competitors are closing down, but you're healthy and financially viable as a business, that means that your market might have shrunk. The size of your potential customer base might have shrunk, but you might be a much bigger player in your market, which means your opportunities for profit will rise. So I think a lot of what we're seeing now is sort of economic Darwinism at work, where the best managed businesses that have enough financial muscle to get through the worst times will survive this as lean, mean racing machines. And they will be the ones that will generate the future profits. And I think that that often happens after a period of economic hardship. And certainly what we see now I would classify as economic hardship. Lunga has asked a follow-up question, which is, what's your view on cryptos? So cryptocurrencies, Lunga, I don't know if you're setting me up for a fierce backlash there, because that's people love to hate you if you don't say anything except positive comments about cryptos. I think cryptocurrencies might have a role to play. I'm not sure. I think it feels to me a lot like what happened in the very late 1990s, when investors started to look at this thing called the internet and how it was going to change the way that we bought and sold goods and how we did business. And there was a massively promising business case for businesses working and thriving on the internet, or using the internet as a tool. And all of a sudden, we saw internet shares absolutely exploding in price. They just went through the roof. The problem is that very few of those companies survived. And the front runners, the ones that were really dominant in the early days, none of them survived. A business like Amazon was a tiny little business in those days, and it became the dominant force. But it wasn't the dominant force in 1999 or the year 2000. And I think that's the danger we face with the whole cryptocurrency revolution at the moment, is some of these front runners might not be the ones that actually win the race. And I could see a business like Visa or MasterCard, implementing blockchain technology in the way that they do business and speeding up their transactions and reducing the cost of doing business. and suddenly, they become a real viable threat to the financial institutions that exist today. My other comment is, I think regulators, hate to be sidelined, and something like Bitcoin. It's impossible right now to know who owns Bitcoin, who owns the actual those coins, and where that value is stored. And unfortunately, a lot of the money that's stored in there is stored by criminals. And as we know, governments are huge on preventing money laundering. They want their taxes as well. So they're going to regulate these things to the point where they can get their share of taxes, and that they know exactly who's financing what with cryptocurrencies. So the opportunities for kind of terrorist money, or money laundering, or drug smuggling money, all of those things, the opportunities are massive in the crypto space at the moment, and that needs to be undone. You can't have criminals dominating a method of exchange. We've seen how that ends, and it always ends badly. Anthony Julies, thanks. And what is the future for the domestic property market? Wow. I think I'll break that market up into two segments. So I think the kind of commercial and retail and industrial space, and then the residential market. So low interest rates are always favorable for property buyers, people that might not have been able to afford to buy property shares when the market was charging 10 or 11% interest rates. They might now be able to afford to buy a home at 7% interest rates. So I think that's a positive story. If we start to see economic growth like most of you have forecast, then I think what happens is we start to see prices rise, because residential property prices are very directly correlated with economic growth. If the economy stagnates, you'll see the property prices stagnate, which is what we've seen. So I think that's a little bit more of a predictable market for me at the moment. Retail space, I have to say, I have no clue. I don't know what shopping malls look like in the future. I don't know how much of us only ever shop online again. How much do we go to shopping malls to go and eat at restaurants, for example? I think it's a very, very unpredictable part of the market. So I have to say I don't know. Office space, similar sort of a question. A lot of us are going to go back to offices one day. We might not go back to the office every day, and we might not all go back at the same time, but we will go back to offices, and we will want more space around us. I think that's one thing we can already learn from COVID, is cramming thousands of people shoulder to shoulder in call center environments. I think that needs to change. So you might find there is more space per person, but fewer people in an office, and I don't know how that unfolds just yet. I think the one big growth area right now, for the next 5 years, will be in the sort of distribution warehousing space, where we see more and more companies, they might have a shop, but they also sell online, and getting distribution to the last mile, to the last person's house across the country is going to be the big race that we see now. Already, my father lives in a tiny town in the Karoo, and 5 years ago, you couldn't courier anything to him. And now there are about 3 or 4 courier companies that will go through that town every single day. And I think that's the growth that we're going to see in the distribution space, and that means warehouses and the like. So I think that's a very positive trend. Overall, I think we need to see these economic reforms now, Anthony, and then I think it could be very positive. I think the listed property market got absolutely hammered in the last two and a half years, and there are great opportunities there if the economy starts to turn. Hetty Folds asking, which media houses do you recommend as trustworthy? Wow. So I'm just going to tell you what I read, and maybe you can read between the lines. I think that News4 provides the most sort of consistent news on a regular basis, not necessarily the best analysis. I read, but I do read that daily, and I do read Business Day online daily as well. And I think it's interesting to watch the innate bias of those two publications. So, for example, after the Sona speech, the News 24 coverage was quite negative. Their analysts and commentators were quite downbeat and quite derogatory in some ways about Sona. You read the Business Day, and it was a bit more factual, and they found some things to be positive about. So for me, those are two that I follow a lot. I do listen to certain commentators. I think the people that Bruce Whitfield gets on 702 and Cape Talk you certainly get good information there. Internationally, I read The Fortune, when it comes out every month, and then I subscribe to the Bloomberg online news service because I think that they provide the best global news I can find. And then on TV, when I listen to the news, which is rare, it's Al Jazeera. I think they understand the international markets. Sherma, I think your topic resonated with me, and we should not engage in knee-jerk reactions on how we manage our investments in the next few months and years, whether this is our own personal investments or our own businesses' investments, but to make careful decisions and in the best interests of the medium to long-term goals. Thanks, Sherma. It wasn't a question. Johan Meyer, government debt needs to be resolved to allocate funds towards infrastructure projects to create future businesses in South Africa. What are the most important decisions or actions required to resolve such that investors and foreign direct investment in the country can increase in the next 10 years? It's a brilliant question. So I think the Eskom issue is a huge one. So to me, I break the Eskom issue up into two parts. The debt issue, the Eskom debt, we keep getting told that this thing is being worked on, that we're going to see the resolution. And all of us are living with this nagging fear at the back of our heads that somewhere along the line, money gets kind of almost nationalized in some way to pay down that debt. And I hope that that's not the case, but we need to see the resolution of that. We need to see the plan from government as to how they're going to resolve the debt issue. So that's 50% of the story around Eskom. The other 50% is that we need to see the transmission company going live at the end of this year, which is what we've been promised. And secondly, that it does become a consistent and reliable buyer of power from independent power producers. To me, that's an absolute game changer where you can get private investors who are willing to commit massive amounts of money to South Africa, provided they get consistent contracts that are reliable and are paid for by the buyers of power. And I think that that's a big issue. I definitely want to see the current two promises from Cyril around the IPP contracts being signed already, that those get implemented now, and then the August round being signed as well. And then that deregulation of the 50 megawatt market. I think that that's a huge issue. I've mentioned land expropriation, that needs to go through Parliament. It needs to get put into law and go on. And then I think all the red tape that we face as businesses, that needs to be diminished. We get told that it's happening, but I don't really see it on scale. To me, it feels, certainly in the financial services sector, that we're getting increasing loads of red tape, increasing regulation, increasing difficulty of doing business, and that's a problem for me. And then maybe around SARS, this issue around VAT refunds, I just wish that they would resolve that quickly, speed up those refunds, and make sure that we develop confidence in SARS. And then the whole corruption issue, that we see proper policing of corruption, people go to jail for committing crimes, and that there are no people that are above the law. I think right now around Jacob Zuma, we need to see that being resolved. I'm gonna kind of stop there on that question. Raju, I doubt that the current electricity infrastructure can support economic growth of 2 to 3%. Has research been done on what consumption increase will be required for 3% growth? I'm pretty sure it has been. If I've listened to Andre de Ruyter do a few webinars over the last while, and certainly I think they're doing some pretty good forecasting models for now. And I think it's important to understand that we don't require Eskom to build power now. What we require is Eskom to switch off the power plants that are unreliable and too old, and then to make sure that the new ones and the newish ones are reliable. And then we need independent power producers to build new power plants in a reliable way. And I think that can be quite scalable reasonably quickly. So I'm not, Raju, I'm not that pessimistic about power, provided we make it easy for private capital to get into that power market now. Anthony, what has been the extent of corruption in South Africa on execution capability across the private and public sectors? I mean, it's the word is what it says. It's corruption, right? So it's a destruction. It's a form of destruction of sentiment. It's a form of destruction of confidence. It's a form of destruction of ability and capability to do things. And we can see that in all the high quality people that were in government, kind of, if we go through the Mbeki era, we had brilliant technocrats that were running ESCOM and the like, and that got destroyed. So in the purest sense, it was destruction of every aspect of our economy. Just look at the auditing profession. The destruction of confidence in the auditing profession is there. We can't hide from that. Not just the individual audit firms, but the whole of the auditing profession has to take a knock. And I think that's so the answer is, in the purest sense, just destruction. I think nothing positive. But that doesn't mean that we can't make it a positive now if we learn lessons from this and take corrective action to prevent this from happening again. Clive, how do you see China position itself with emerging markets coming out of this global pandemic? So it's been studied quite a bit around, if you want economic reform and you want economic growth, it works best in a quasi-dictatorship, because it means that at a central level, the dictators can take control and make decisions which might be unpopular in the short term, but might be good for economic growth in the future. I'm not advocating for dictatorship. I think that's destructive to everybody over long periods of time. But what it means for China is that they can make some fairly tough, fairly unpopular decisions that might be destructive to a segment of the Chinese population or to the Chinese economy, but constructive to the whole of the Chinese economy. And I think that they've got a long history of doing that. And I think that's what's going to happen. They're going to drive reforms that they need, and they will be the clear winners out of this whole pandemic. I think their kind of growth rate to kind of go on par and then exceed the US as an economy was accelerated through the pandemic, and we can see the sort of political stagnation in America, where the Republicans will oppose the Democrats almost on principle, irrespective of the quality of the plan. And that's the one downside of a democracy, is that sometimes the democratic processes slow down economic reforms, and politicians become afraid of taking some short-term tough decisions. And the Chinese politicians clearly don't have that fear. So I think they will come out of this better. Is it good for the Chinese, the average Chinese person, and the quality of life and all those things? You'll have to be the judge. Dennis, how do you see future tax regimes affecting the local economy in South Africa and the region? It's a good question. So I have to start by saying I don't know, but I'll give you my view. I think we are overtaxed in South Africa. I think our tax regime is not business friendly. We don't have enough incentives for businesses to make long-term decisions that cost the company in the short term, but help grow employment, help grow the country overall. And so I think we need to see more of that. I think we need to see policies that are super investor friendly, but not investor friendly so that investors who put in rands just make more rands. I'm saying investor friendly so that someone like me who employs people in a company would say, I'm happy to delay profits and to reduce profits on the basis that I'm going to pay less tax, but I'm going to employ more people. I'm going to grow, I'm going to do my part to grow the economy. At the moment, I feel like the tax regime is prejudicial to me. It's actually, I should almost do the opposite of what our country wants. And as a good South African, I'm not doing that. But I would like to see investment incentives, that encourage me to employ more people. Stop putting hurdles in my way to help me employ people. Let me employ people and make it easy to hire people, but that means make it easy to fire them, and give me a tax regime that gives me incentives to employ. At the moment, the tax regime we face, I feel, incentivizes capital deployment. In other words, farmers are going to have more machines, miners are going to mechanize more, and they're not going to employ people because both the tax regime and the labor kind of market here is prejudicial to employers, in my view. And I think that's not the long-term interests of the country. I'm not really sure about the region as a whole. I think one of the comments I'd like to make is I think that this kind of common market that we will see in Africa, if it works, and it actually happens in the next decade, it's massively positive for us. And I think trade tariffs between African countries, those should be abolished. And the more free trade we get within the region, that will be massively positive for South Africans, yeah, for South African companies, yes, but for international companies as well. Just looking at how difficult it is, for example, for a migrant worker in South Africa to send money back home. You end up, you see that, a Malawian migrant worker in South Africa probably loses 10% of their savings by the time it gets to home because of fees. And that kind of thing should just disappear. Offense, hi Warren, you mentioned the 1%, and I guess whatever the next level is, I think that's the 1% of the 1%. That seem to have access to finance and or assets that they can invest overseas, and that we don't know what will happen in the future. What about the higher percentage that is not financially well off to target the overseas and sometimes local market? What possible investments are there within their reach? Are you saying that the overseas markets have a better dependability, unlike our local and African markets? Has COVID not shown that no market is a sure thing? Or is there one that is less volatile than the other? Offense, I think the reality is that smaller markets are always more volatile, and the same would apply to a smaller share versus a bigger share. So smaller markets where governments can have a bigger impact on the direction of a market through policy changes will always make them more vulnerable to change. So when the world goes into a state of fear, what happens is the biggest markets attract the most money or fall the least maybe, and the smallest markets lose the most, because when people become fearful as a globe, they try to de-risk, and they view emerging markets as the riskiest markets in the world, which is also possibly when the world turns in favor of taking risk, that's why emerging markets will work again. Having said that, for a South African, you could open up an account at I'm not paid by them, so I'm hoping you're not offended, but a company like Exchange for Free, not Exchange for Free, ETF SA, or I think there are a whole range of them, that will allow you, Satrix, for example, that will allow you to, with 300 Rand a month, buy an investment that, that will give you exposure to the global markets for 300 Rand a month. And I think, to understand that, that's approachable for quite a few people in South Africa. Certainly not every South African, but I think, if you can commit 300 Rand a month or 1,000 Rand lump sum, you can buy an exchange traded fund that buys the MSCI world market and get exposure with that 1,000 Rand lump sum or 300 Rand debit order. So certainly, I think that makes the market slightly more democratized for South African investors. We've got a lot to do to make it approachable for people with 50 Rand a month or 10 Rand a month. But I think the industry is working in that direction. So I'm not saying, for example, that you have to wait till you've got R1 million and then buy dollars and send the money overseas and then go get your international exposure. You can do it with $1,000. Martinez, how do you see the fourth industrial revolution and other automation impacting the economy, employment, and buying power over the medium to longer term? So it's an interesting question, because people always think that a technological leap creates less employment. And this goes right back to the days when we had manual labor and we implemented steam-powered machines, even before electricity. And the opposite is always true. So yes, we'll see certain mundane jobs that can be automated will cause people to lose jobs in one sector. But what it does is it creates a whole new range of jobs in other sectors. The question is whether those are good jobs, whether they're sustainable jobs. But if you look at someone who, for example, only has a driver's license in South Africa and has no access to capital, they can, it is possible for them now, because of technology, to get a job driving a car for Uber. That wasn't possible 10 years ago. It would have been, they would have had to buy taxi licenses and the like. And I think that those days are high capital barriers for individuals to get some kind of work. Those days are disappearing. It's possible for us now in a format like this to service clients right around the world. All of us. If we work in the service industry, we can cater to clients anywhere in the world with the advent of technology. So I wouldn't be afraid of technology. I think the concern I have, Martinez, is that we need our data costs to collapse. We need them to really fall and make data costs viable and approachable for anybody in South Africa. So if you're living at home in a tiny rural town, the far north of the country, you need to be able to get access to data at a reasonable price so that you can get education online and you can access the global markets in one form or another. But I actually see that as a huge positive, not a negative. John, investing in overseas markets can be complicated for the man in the street. Do you see exchange traded funds as an easier way to do these types of investments and achieve a similar outcome? Absolutely. To me, I think the easiest way to invest overseas is buy one exchange traded fund called the MSCI World Index. You get access to over 1,000 companies that are running very well across the globe. You're investing in a geography from the west coast of America to the east coast of Japan, and the top of the world down to the bottom of Africa, and it's in one investment. And as I mentioned earlier, you can access that for 300 Rand a month or 1,000 Rand lump sum. To me, that's it's an easy way to go in. And even a wealthy investor like Warren Buffett recommends exchange traded funds for investors who are not share experts. And so Warren Buffett's much smarter than me. He's made billions more dollars than I ever will. If he recommends it, who am I to argue? And in fact, I agree with it. So I don't think it needs to be complicated. I think that you can do it very simply. I hope I'm saying your name right, Hasnikant. Do you foresee South Africa becoming the engine room to spur African growth, or do you foresee another African country becoming the engine room? We are the most industrialized, so we have a head start, but we need to have a much more investor-friendly government that kind of looks at taking the tough, maybe unpopular decisions that are not just pro-union but pro-business, and if that happens, we should be the engine for growth. But you're seeing massive fiber lines being laid, fiber cables being laid on the west and east coast of Africa all the time now by a range of new companies. And if data costs become cheaper in the rest of Africa than they are here, and we see that sort of digital migration happening faster in Africa, which we are, then the countries with bigger populations, with lower data costs, and a more progressive government that's business friendly could easily overtake our lead. So I'm not forecasting that as the scenario I see, but I can see the dangers if we don't catch a wake up soon as a country. But we have incredible entrepreneurs in South Africa, and I think that's our big advantage we have here, is we know how to do business. And I would say Southern Africa, maybe not just South Africa. I think we're almost out of time, so I've got one more question that I'll answer. What's your view on SAA and the impact on jobs if government does not support? Can sustainable jobs not be created with the government funding, creating economic growth? Airlines don't make money. That's the bottom line. Airlines are the most cyclical industry in the world. They tend to survive only with government support. And in my view, if there's a public-private partnership with government as an investor, very much like the telecom model, and you have the business being run as a business rather than for kind of ideological grounds, then maybe it can survive. But I think we need to understand that the airline business is all about a hub. If you look at Emirates, it operates out of a hub. If you look at the American airlines that survive, and they're not many, they survive because they have big hubs. And Johannesburg or Cape Town can't be a hub because we're too far away geographically from big markets. So so just simply the best place to put a big hub in Africa would be in the middle of Africa, literally. And that becomes a regional hub for the continent, and that would keep airlines viable. So we need to partner with the private sector as a country, and we possibly need to partner with other hubs to make sure that we can get some benefit. But I think government shouldn't be in the business of business. Government should be ruling and providing a regulatory environment, and business should run business. To me, that's the most efficient way that I think it works. Maybe not, to make our politicians happy, but that's my view if you're asking for it. So on that note, I think it's 10:01. I'm gonna stop there.
Sorry, Warren, I actually wanted you to move to the next slide, last slide, but it's fine. Thank you so much for joining us this morning. I think from the chat groups, we've seen already the feedback from our members that this has been an enlightening session and very informative. I think everyone's enjoyed your arguments and the views and thoughts that you put across. So thank you so much for joining us this morning, Warren. And thank you to all our members giving us their time as well. Please do complete our member survey. I'll just ask Vus to just put that in the email that you'll get afterwards, and give us your feedback and let us know what else you would like to see and hear on Boardroom Bytes at 9. Otherwise, from all of us, we will see you again next week, same time. Thank you so much. Bye-bye.
Thank you.